Stocks at record highs. Inflation fears bubbling up again. And Trump and Powell are still at war. And tariffs, yeah, we have those too. And the numbers aren't small. Investors are nervous, wondering if we're already on thin ice, replaying the dangerous days leading up to the dotcom crash. Look, I was there. My early days as a portfolio manager at Lehman were about to get a big wake-up call. Prince was on the radio singing 2000, party's over, out of time. Tonight, I'm going to party like it's 1999. And maybe you're feeling a little of that deja vu right now. Let's start with that. We know the market climbs a wall of worry, and we often look for data to support the call to get out, pull the ripcord. Valuation might whisper bubble, but history shows that valuation alone is a pretty lousy timing tool. Yes, stocks look pricey compared to other asset classes and even to itself, but remember they looked even worse in the mid-90s, but still had a few more years of dancing ahead. So maybe, just maybe, it isn't 1999. Maybe we're partying like it's 1995. It's time to dig deeper, question the assumptions, and more importantly, separate the noise from signal. Are you with me? Welcome to The Money Runner. I'm David Nelson. Is it safe? That's always the question we ask ourselves when we're committing capital to the markets. You look at this chart over the last 100 years, there were plenty of times it wasn't safe. I've lived through a few of these. The dot-com bust, 2000 there right in the center. A few years after that, the financial crisis. And of course, COVID in 2020. Who could have done anything about that? Seemed like the end of the world. Came close to it. The 2022 bear market with rates rising. Pretty ugly time to invest. And of course, today, tariffs and the concerns over that. What is it going to mean for the economy? What is it going to mean for earnings? And of course, the geopolitical backdrop for that all weighs in on that wall of worry that we live with each and every day. And those are the concerns that drive investor fear and also force some bad decisions. So we need some tools. Valuations don't live in a vacuum. They have to live relative to an alternative asset class. If I'm not going to invest in stocks, where am I going to put the money? So the most obvious place is a risk-free treasury. And we use the 10-year because in many ways it's a proxy used in the economy. It is the trigger for your mortgage rate. A lot of credit card rates key off where the 10-year is. So it's a pretty important metric there. You've got the S&P 500 going back from 1995 to today on top. And below that in green, you have the earnings yield. The earnings yield is just the PE ratio turned upside down, where PE is price divided by earnings per share. And earnings yield is just the earnings of the company divided by the market cap, the size of the company, all right? So we get a yield, much like a dividend yield, all right? That purple line is the 10-year treasury yield, all right? And just looking at the chart and looking at the green line and the red line, pretty easy to see that when the green line is above the red line was a pretty good period for stocks, all right? And you can see what I've circled there, those peaks and the green line. That's when the earnings yield was above 6%, all right? Those were pretty attractive times to invest. And you can see it coincides with some pretty big dips in the market. You can see a couple of years after the dot-com bust on the left side of the page, that big peak in the middle, that's the financial crisis. However, I will tell you that even with earnings yield at 10%, stocks were pretty scary then. You were catching a falling knife, all right? Then, of course, you got 2012, and then that last one, that's really the dot-com in here. But if you look to the right side of the page where we are now, almost by definition, you'd have to say our market is pretty expensive relative to history, relative to other asset classes, even relative to itself, right? Kind of expensive. Yet stocks have pushed even higher. Is that the signal for something ominous, a crash? Well, like I said at the top, valuation is a pretty lousy timing tool on its own. Zoom in all the way to the left side of that page there, and you're going to see that the 90s, this is the mid-90s, 1995 through 2000, were much worse. Treasury yields were much higher. Earnings yield was much lower because stocks were just going straight up. So let's see what stocks did in that framework. Well, if you drill down and let's look at 1995 through 1996, all right? We had a down year in 1994, so probably a good place to start, the run up into the bubble. And from the end of 94 to the end of 96, stocks put in about a 65% return. That was kind of early in my career. I started to believe as a portfolio manager, I started to think, well, this is the way it is. Stocks average about 20% a year. This is what's hard about this job. I started to think of that as a sacrosanct, or rather, that was the norm. All right. So let's say you pulled the ripcord at the end of that period. You probably would have felt justified in doing that, because remember, valuations weren't very attractive then. Let's look at the next few years. If you did that, all right, you missed almost 100% move during that period of time. If you pulled the ripcord at the end of 1996, I'm going to repeat that, 100% move. So at a time when you thought markets were pretty overvalued, if you got out, you missed a hell of a ride. So let's go to our markets today. Here we are the last 3 years, really since the bull market started, all right? And you can see there the bear market low of late 2022. Markets looked pretty dark back then. Since then, even with the tariffs up and downs, U.S. markets up about 79%. I believe that's without dividends, so it's probably even more than that. So it begs the question, do you really want to pull the ripcord right here? Okay, if you're still with me and you've decided to stay in the market, we have to get a sense of what conditions on the ground are. So let's take a look at some metrics out there that we should be aware of at the beginning of an earnings season, which has started really a couple of weeks ago. In this past week, we had some of the big banks, J.P. Morgan, Wells Fargo, Citigroup, Bank of America, I think Goldman reported. So what do we know so far? So according to Goldman Sachs, David Kostin, their top economist, of the firms that have reported so far, 61% of the firms have beaten estimates by more than a standard deviation, and that's apparently above what's typical. I think it's more like 48%. So far, the earnings season is kicking off, and we're starting off pretty well. This chart on your screen may be the most important for me because I look at estimate revisions, an important metric in the quantitative models I build, and as long as I see that green line, which is estimates for the S&P 500 up and to the right, that's good news for me. That tells me that maybe there's still some gas left in the tank. I still think that this is going to be a stock by stock story, because I look at my screen and I see dozens and dozens of stocks up 20, 30, 40, 50, 60%. But I also see dozens of stocks down 20, 30, 40, 50%. So obviously a very bifurcated market, the haves and the have-nots. And so some stock selection here can go a long way to enhance returns. One of the things I focus on is where analysts are with the securities that they follow. And one concerning metric for me is analysts who are keeping buy ratings on stocks, yet the stock is at their price target already, right? So look at a few of these here. So this first one here, IBM, all right? And this is a stock I own, by the way. I own it in dividend portfolios. That top line on POP, that's the highest target out there for that some analyst has out there. The one on the bottom, of course, is the lowest target, and the one in the middle, the orange line, is the consensus target, and the blue line is the price of IBM. And IBM is actually above the consensus target right now. Yet a lot of analysts, still like this stock. Another, J.P. Morgan. Really going into its earnings report, it was really at the consensus target. It's a relatively expensive security, but it's probably the best bank on the planet. So I'm not sure that being out of the stock for any period of time is going to be all that helpful. Yet you could see that even off of a pretty good earnings report, the stock really didn't react well, at least on the first day. The stock traded lower. We saw the same thing with GE. GE was already at its target when it reported this past week. It was a fabulous quarter, but it's not cheap. It is relatively expensive, and it's probably going to have to, grow into its earnings. But it's a pretty high quality company, and most people don't want to part with the shares, at least not yet. But it was already at target, and yet it traded lower. Netflix, same thing. There's a lot of companies out there that people look to buy that they're hoping are going to be the next Netflix. Well, you could buy those, or you could buy Netflix, which is probably the top streamer out there. But it was trading at or above its price target on the day it reported earnings, and it wasn't a perfect quarter. And I own this stock, and I have to make a decision on whether or not I want to continue to own it. And if it pulls back much further, maybe I'll add more. But I'm going to have to dig into this because one of the metrics that was in that quarter that was a concern, despite the fact that it is the leading platform and so many people are watching Netflix, and it's become such a profitable engine here. The one metric that was disturbing to analysts was the fact that the average viewer is spending less time on the platform. And I must tell you that I find that as a consumer, even though I watch a fair amount of Netflix, I found some other platforms out there that have some pretty awesome material. I think Paramount's material is fabulous. I think some of the series they've run. I was a real fan of Agency with Richard Gere. I thought that was a fabulous series. There's several others on the platform that people are excited about. Lioness is another, and Landman with is it Billy Bob Thornton? Yeah. Just fabulous series. So there are choices out there. Maybe that's going to weigh on the valuation of Netflix. But analysts want to stay in love with the stock so much that it's become almost comical. Take a look at this one right here. This one I love. This guy's name is what is his name? I believe it's Wang Ting in the center of the page there from, I believe it's SDIC Securities. All right. Got a buy rating on the stock. This is the day before they reported. Yet his target was $808. All right. Several $100s below where the stock is trading. He's still got a buy on the stocks. That's a committed analyst. He's not going to go to a sell rating, even though the stock is trading, $400 above his price target. I don't know what to say about that. So are we overly bullish? Well, yeah, maybe. But nothing changes sentiment like price, and we're certainly seeing that right now. Before we close out this week's podcast, I want to take a look at what we can expect next week, what's on deck, and let's review what's taken place so far in earnings season. It's still early. Only a handful of names have reported. Last week we had J.P. Morgan, Wells Fargo, American Express, General Electric, Netflix, Goldman Sachs, a handful of other names. But of course, it is still early. So how are we doing? Well, David Kostin over at Goldman Sachs put out a note on Friday, and so far pretty good. What he's reporting here is that 61% of the firms have beaten estimates by more than a standard deviation, and that's apparently well above the 48%, which is typical for a quarter. So it begs the question, how important will the Magnificent Seven be, given that there's such a significant portion of the market cap of the large cap index? And what percentage of growth are they going to represent? Well, this comes from FactSet. And of the growth we can expect this quarter, and it's not much, all right? We're talking maybe earnings being up 5 to 6% over last year for this quarter. 14% of that growth is going to come from the Magnificent Seven, regardless of how they perform versus the S&P 500 this year. You can see on this chart that NVIDIA is now retaking the crown as the largest company. Underneath that is Microsoft. Meta has also done well, but those are the only three that have actually beaten the S&P 500 year to date. Everybody else is bringing up the rear. And two of those names bringing up the rear report next week. Alphabet will be first. I believe they report, I'm guessing here, on Wednesday. And they're going to have to answer the question. We're going to have to get a report card on how good or bad they're doing versus OpenAI, which is clearly cutting in to their search. Now, a lot of analysts talk very, very highly of Alphabet's Gemini and how they're rolling that out and weaving that through their infrastructure of products that they have. I've used Gemini, and even though I own the stock and have added to it recently, I haven't been all that impressed. I actually still prefer ChatGPT, and coming up fast is Grok. Grok is becoming very, very powerful, and maybe growing the fastest out of those three. Nevertheless, we're going to get a report on Alphabet, I believe, on Wednesday. Tesla, towards the end of the week, I don't know what to say about Tesla. Everybody's still trying to figure out whether this is a car company, a software company, or is it an AI company. I guess it's going to be whatever Elon wants to make it. But this large cap dominance by the Magnificent Seven is playing out in the market as well, because you can see the S&P 500 is hands down the winner versus mid caps and small caps. And this trade right here, this chart, we addressed on our call here at Belpointe on Thursday. Why aren't small caps performing? Portfolio manager, talking heads, and analysts have been talking about small caps taking over the market and playing a catch-up trade. I've been listening to that rhetoric for the last 3 years, throughout this entire bull market cycle, and it hasn't taken hold. And it was brought up on the call that maybe part of the reason is capital structure and what's taking place in the market. A lot of companies have chosen not to go public. Companies are staying private longer. In the old days, a company would need access to capital, so they'd go public. They'd probably become a small cap stock, end up in the Russell 2000, and some of these would be the next Amazon. They grow, become a mid cap, then a large cap, end up in the S&P 500. Today, some of these companies are staying private so long that by the time they finally come public, they're going to be massive stocks. They're going to end up in the S&P 500. I can think of two off the top of my head that will fit that bill at some point in the future. Certainly OpenAI. Who knows? Maybe that'll come public with $100 billion, valuation. Same for SpaceX. Whenever that comes public, it's not going to be a small company. Therefore, I think the small cap index by and large is challenged, and I would say avoid it. Stick with what's working. Stick with the larger cap names. That's where the growth is. All right. That's it for this week. It's Saturday. You're going to probably see this on Sunday. I'm going to try to get back and get something done and save whatever is left of my weekend. I hope you have a great weekend. Don't forget, if you want to learn more about yours truly and the Money Runner, go to my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is the Money Runner.